Welcome to Business with Louis, the show where we dive into the world of entrepreneurship and explore the concepts that drive success. I'm your host, Louis, and today we're talking about risk versus return, a fundamental idea that every business leader should grasp. So, what is risk versus return? In simple terms, it's the balance between the potential for gain and the possibility of loss in any business decision or investment. It's a trade-off that entrepreneurs and investors face every day, and understanding how to navigate this trade-off is crucial for achieving success. The concept of risk versus return has been around for centuries, but its modern application in business dates back to the 1950s, when economists like Harry Markowitz developed the modern portfolio theory. This theory posits that investors can optimize their returns by diversifying their portfolios and managing risk. Since then, our understanding of risk versus return has evolved significantly, with advances in finance, technology, and data analysis. At its core, risk versus return is about making informed decisions that drive growth while managing risk. One key principle is the idea of expected value, which calculates the potential return of an investment based on its probability of success. Another important concept is diversification, which involves spreading investments across different asset classes to reduce risk. The capital asset pricing model is also a crucial framework for understanding risk versus return, as it helps investors estimate the expected return of an investment based on its beta or volatility. Let's look at some real-world examples that illustrate risk versus return in action. Consider the story of Amazon, which took a huge risk by investing heavily in e-commerce and cloud computing. While there were significant potential losses, the company's bold bets paid off, and Amazon became one of the world's most valuable companies. On the other hand, companies like Enron and Lehman Brothers failed to manage their risks effectively, leading to catastrophic consequences. Another example is the case of SpaceX, which has taken enormous risks in pursuit of innovation and growth. By investing heavily in research and development, Elon Musk's company has achieved remarkable success, but not without facing significant challenges and setbacks along the way. These examples demonstrate that risk versus return is not just a theoretical concept, but a practical reality that businesses face every day. So, how can you apply risk versus return in your own ventures or careers? First, it's essential to have a clear understanding of your risk tolerance and investment goals. This will help you make decisions that align with your overall strategy. Second, diversification is key. Spreading your investments across different asset classes can help manage risk while still pursuing returns. Third, stay informed but avoid emotional decision-making. Market volatility can be unsettling, but it's crucial to stick to your plan and not make impulsive choices based on short-term market fluctuations. Furthermore, entrepreneurs and investors should consider the concept of risk management in business. Risk management involves identifying potential risks and taking steps to mitigate them. This can include strategies such as hedging, diversification, and insurance. By managing risk effectively, businesses can reduce their exposure to potential losses and increase their chances of success. In addition, research has shown that companies that prioritize innovation and R&D tend to have higher returns on investment, but also face greater risks. A study by McKinsey found that companies that invest in digital transformation are more likely to achieve significant revenue growth, but also face increased risks related to cybersecurity and data privacy. To apply risk versus return effectively, it's essential to have a solid understanding of financial metrics such as return on investment, internal rate of return, and net present value. These metrics can help you evaluate the potential returns of an investment and make informed decisions about whether to pursue it. Additionally, tools like decision trees and scenario planning can help you visualize potential outcomes and manage risk more effectively. In conclusion, risk versus return is a fundamental concept that every entrepreneur and business leader should grasp. It's about balancing the potential for gain with the possibility of loss and making informed decisions that drive growth while managing risk. As my experience with market cycles has taught me, understanding this concept can be the difference between success and failure. To summarize, the key takeaways from today's episode are: understand your risk tolerance, diversify your investments, stay informed but avoid emotional decision-making, and consider the concept of expected value when making decisions. By following these principles and staying focused on your goals, you can navigate the complexities of risk versus return and achieve success in business. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.